Hi and welcome everybody. Of course, I am your host, Scott Royal Smith. I'm here broadcasting with Live Today with Amanda Hahn from Keystone CPA. She is the absolute ninja in all things tax related with real estate investing. She has a book out on Bigger Pockets. She's a huge name over there, and I've worked with Amanda for years on tax for a number of clients here at Royal Legal Solutions. So it's my pleasure to bring Amanda onto the show today. If you're here in our watch party, that's part of our group here, you're going to be hearing this presentation live. If you're here on the podcast, I encourage you to be able to come and do these, attend these presentations live with our watch parties that we have with our expert guests, with these recorded calls, with my attorney staff in here answering questions for us as we go through the presentations. It's an extreme amount of education in a very short amount of time, and it's designed intentionally to be that way. So if you're hearing this online, join in on the watch parties, connect with us to the royallegalsolutions.com website and get plugged in on how you can attend these shows. So Amanda, the absolute CPA ninja from Keystone CPA. Tell us a little bit about like what things are important for people to know, because as you know, we're all real estate investors. We're on the path to financial freedom here inside of this group through our real estate investing. And I'm just curious, Amanda, where do you see yourself inside of the journey that real estate investors have when they're looking to get through their financial freedom in real estate investing?
Yeah, well, first off, thank you so much for having me. And I want to say hello to everybody here. This is my first watch party. I'm super excited to be here. So, I mean, in terms of what my role is for real estate investors, just a little bit about me. I'm a real estate investor myself. One of the reasons that I got into real estate investing is actually for the tax benefits of it. Earlier in my career, what I did was to help other people save taxes using real estate. At some point realized, hey, this is something I should do for myself as well. So yeah, having a team together, as a real estate investor, having a team together to kind of bring all the different pieces, I think is super important. And I'm also happy to be here too, because, with the clients we work with, probably one of the most frequently asked questions are, what kind of legal entity should I be? And then we always say, hey, you got to bring in an attorney. And I know for you, Scott, you probably get it all the time where people say, hey, what about this and that? And you say, well, you need to go ask your CPA. So it's so awesome that we're both here and, they can ask us questions at the same time. But yeah, I mean, the way I look at it is, every dollar saved in taxes is maybe $4 or $5 more that you can invest in real estate. So if you can save $20,000 in taxes per year, that could be a down payment on another property that you buy for $100,000. So a very, very impactful piece of the puzzle when you're trying to reach financial freedom.
Yeah, I mean, it's huge, right? Like the number one thing that we have to do, right, is increase our top line revenue. And after we increase top line revenue, it's defense, isn't it? Like how many dollars can you save off the expenses? How many dollars can you save off of taxes? And then ultimately that gives you total dollars left to invest. And those are your soldiers. You got to put those to work, getting those motivated inside of the right investments. And when you get that all working, then you're able to get on faster on the track to financial freedom. And the biggest savings I've seen people make is one is getting tightened up on the expenses. People always seem to spend more money than they think in their mind. If you ask somebody, what are your expenses? A lot of people say, I don't know.
Yeah.
To me, I'm always like, well, whoa. How do you not know what your expenses are if you're committed to increasing the amount of money you have invested into it? And the second thing is what is what's your effective tax rate after we get into it? So I know a lot of people are out there like, well, my tax, I make $150,000 a year. My effective tax rate is north of 30% of what they pay. And when I usually see like those kinds of things, I was like, wow, there must be a really good reason that you're paying so much in taxes. Like you must be really limited on your strategies. And most of the time that's actually not the case. It's just because they haven't considered a really like in-depth look at what are all of the options that are available to them. And I guess I was curious, Amanda, is like, what do you typically see with people coming into your office? Like, are those pretty clear numbers from your firm about like, hey, this is where most people come in and this is usually where you're able to get to if you're using some of the more advanced strategies?
Yeah, I mean, it kind of differs because, we work mainly with real estate investors, but it's kind of through the gamut. We have people who all they do is real estate. Those are typically the people who have very low tax rates, and they might be still making a lot of cash flow and stuff, but a lot of strategies to reduce taxes. We also have people who are heavily W-2. maybe just starting out in real estate, maybe just one rental to start off with. Typically, those are the people that are much higher tax rate. And it takes, maybe a year, 2 or 3 years of planning to really see a very significant shift, from a very high bracket down to a lower bracket. But it's interesting you say, someone making 100 or 150,000 saying that they pay 30% in taxes. A lot of times when I ask people how much they pay in taxes, they quantify that in terms of refunds that they get. And that's not a good way to look at it, right? Because you could be someone who, have a job and are withholding way too much. And by the end of the year, you get a huge refund and you think you're doing really great. But what's really important is to look at what is your true tax rate, like you were saying earlier, right? Your effective rate. How much did you actually pay in taxes based on your total income? And then the other thing is people only look at federal income taxes. So people that live in states that have higher tax, California, New York, Illinois, that may be another, up to 10% or more, right, on top of your federal income tax. And of course, we all pay, property tax, payroll tax. So the Tax Foundation, which is a nonprofit organization, came out and had indicated that the average American spends more money in taxes than they do on clothing, food, and shelter. Right? And shelter is huge. That's like our mortgage, our rent. So we spend more in taxes than all three of those things combined. That's how much the average American is losing to taxes.
Not us though, as real estate investors, right? As the more we get into the real estate investor game, we're gonna let everybody else pay all those taxes.
Yeah, real estate investors are never average. I think we're some of the most creative people that I meet.
Yeah, absolutely, right? Always looking for the angle. Like, how do I structure this better? It's like the true entrepreneurs of the investing world as it comes into, right? And I think that's why I love real estate. That's why I like working with, I love working with real estate investors myself. It's because I just love that entrepreneurial spirit of like, how can we get through? And I know in coaching people through the investing side of things, the way we've typically looked at way we structured things in World Legal Solutions is looking at, great, let's get the foundations and the structures of your assets, right? You have the money, now we have the money into assets. Now we have the assets, let's protect the assets, get the right infrastructure in place for S corporations, series LLCs, DSTs, whatever the case may be, to use those. And then we'll look at, great, now we look at, okay, now let's proceed on to tax of like, okay, what are the deductions we should be taking, retirement accounts, irrevocable life insurance trusts, et cetera, like what are those other considerations that come through? And so in our kind of stages that we walk people through, ending with calls that are like this, which is what's your ongoing education and pulse on the market, which we're also bringing into these shows. And that first stage of the asset protection come through. I know you're really familiar with the things that we do here at RLS, but I was wondering just in general terms, if you see like what are the general strategies that people are the general setups you see that people are using, and at what like income levels do you see people changing those strategies of like just the company infrastructure?
Yeah, and again, that kind of runs the gamut. I sometimes come across investors who own, a dozen rental properties all in their personal name. And I sort of have like a panic attack moment because no one ever talked to them about asset protection. And then we have people who come to us really early in the game, and they've learned from other investors to say, hey, I'm starting out. Now is the best time for me to get started correctly. So I'm not in the wrong entity, which I'm sure we'll talk about in a little bit, what happens if you're in the wrong entity, very painful and costly sometimes to unwind. But I think, so for most of the investors we see, that are doing it correctly, they're holding rentals in some sort of flow-through entity, right? Usually LLCs, DSTs, or partnerships. And from a tax perspective, that's really beneficial because, as real estate investors, one of the biggest perks we get is the whole concept of deductions and depreciation. And so when we create these losses by maximizing, our home office, our car expense, or we're shifting income to our kids, at the end of the day, we're trying to utilize those losses to offset other income we might have, whether it's like a W-2 income or, capital gains from stocks. And so it's really important that on the entity structuring side, that you have the right entity so that the losses are flowing through to you, so you can use it to offset your personal taxes. In terms of like simplicity or complexity, I usually leave that up to the investor and their attorney, because, that's kind of outside the realm of my expertise in terms of how many properties in one LLC, and, do you need like a holding entity? But what I really like about what you do is to really try to simplify things, because we've worked with some attorneys that just have very, very complex structures that result in a lot of tax returns and a lot of costs. And those are things that I'm always looking out for, because I think at the end of the day, for the investor, from the investor's perspective, what we really want is like the best asset protection with the lowest amount of cost, like annual cost and maintenance. Because for me, I don't want to charge someone to do a tax return unless it's absolutely necessary. So to the extent we can have entities that are, what we consider disregarded, where they don't have to file a separate tax return, but they also provide the asset protection, that's always my personal favorite.
Yeah, to me, it makes the most sense because like it's keeping the eye on the ball, right? Which is total number of dollars I have left at the end of the year to invest, right?
How much money am I keeping from all these investments, right?
Yeah, exactly, right? Because that's the goal, right? And the goal is like financial freedom, right? So it's dollars at the end of all of the calculus, right? It's not just sitting on like, oh, my effective tax rate. It's also like, how much did it cost me to prepare all these returns to go with it? And how much money am I making? Like that's one of the things that I tell people is like, hey, well, yeah, you can do as corporations, you can save on self-employment tax. They're like, well, when can I do that? It's like, well, technically speaking, you can do that at any time. When does it make sense to do it? It's usually about at $50,000-ish per year, because it's the cost of the tax return you have to factor in with it. And they're like, oh, I didn't realize. Yeah, right, because it's not just about tax, right? It's about the larger scope. And that's why we typically talk about like, cool, let's walk through the gates and the stages of like what makes sense for us at where we get into. So so when we're talking about asset protection, we're talking about series LLCs, LLCs, DSTs, S corporations, as well as in some circumstances, some types of C corporation strategies, depending upon what the expenses might look like, right? Like high education expenses, medical expenses, those kinds of things coming through. I was wondering I just had a client the other day actually that had called me up and said, hey, listen, I have a property. I have a series LLC that I had formed through another a tax advisory company that wasn't a CPA into it. They set me up with this structure. It turns out I only moved in one property. I didn't move any of the other 7 properties that I had into this. And then what they did is they formed me an S corporation. And then to capitalize the S corporation, they moved in my car and they moved in one of my pieces of real estate into it. And I was like, holy smokes, I can't imagine how much worse this could have done. Like what the quality of this advice was. And so he's like, I know. I was like, hey, listen, don't worry. We're going to be able to look at that and be able to do that. But that's a common story I get, is that people will do inappropriate moves, especially as moving real estate inside of S corporations. And I was wondering if you could share with us a little bit about why is that so bad, and what do people do if they find themselves in that situation?
Yeah, that's unfortunately somewhat common mistake that we see. So yeah, I think the 2 most common mistakes, one is like what you said earlier, people have the LLCs, but the properties are not moved in. I'm doing, at the end of the year, every year, we contact clients and say, hey, tell me all of new entities that you formed or dissolved this year, if you haven't told me already. And this is where we get, hey, I formed ABC Holding Company. Of course, the follow-up question is, well, what does it do? What does it hold? Well, we're supposed to hold this property, but it's not doing that yet, right? So then we kind of go, okay, well, let's, finish the process. Because if you just have an entity that's not holding your asset, then, the LLC is not really providing protection for the property, right? You're still the owner. On the S Corp side, one of the main reasons we don't suggest investors hold rentals in an S Corp, well, a couple different reasons. One is that when you have to take title out of an S Corp into your individual name, that's actually a taxable event, which seems sort of ridiculous, but the IRS treats it as if you sold the property to yourself from your S Corp at fair market value. So if I have a property that I bought for $100,000, it's now worth $150,000. I have to move it out into my personal name. There could be taxable gain of $50,000, even though I've never sold it. I'm just simply moving it. And so the question becomes, well, why would I do that? Why would I move into my personal name? most common reasons we see would be financing. Sometimes the banks don't want to finance inside of an S corporation, so they'll force the owner to take it out in the personal name, refinance, and then maybe you can put it back. So that creates, a somewhat significant problem if you have highly appreciated assets. We're talking about 50,000, but it could be a 500,000 appreciation, and that becomes a very painful process to do. So, one of the things is, I said, I do sometimes see clients that are, have properties in there from years and years ago. And so it's a difficult decision to make and say, okay, how, do we want to unwind this and have that exposure of potentially having, a significant amount of taxes that are due. The other reason, major reason that we don't like S corporations is that there's what we consider basis issues when property is held inside of an S corp. So if you hold real estate in an S corp that has leverage, okay, and most real estate investors have leverage, to the extent that you have a huge loss from depreciation and things like that. Personally, you might not be able to utilize that leverage loss because it doesn't give you basis as a shareholder. And so what happens is, you got someone owning like an apartment building. If it's in an S corporation, it's creating this, $50,000, $100,000 loss. Looks great on the K1, but when it's time to prepare your personal returns, there's sometimes is a limitation where of that $100,000 loss, maybe you can only use 10, 20, or 30,000 of it because part of that was the result of leverage. And so those are two, very important reasons why we don't hold real estate. And really all, most appreciating assets, we don't want to hold them inside of an S corporation. Those two problems I just mentioned do not exist in LLCs, do not exist in partnerships. So we have highly leveraged real estate in a partnership kicking off losses. The individuals can utilize that. It doesn't give us any basis issues. And then on the refinancing, if you have a rental in your personal name, move it to the LLC, move it out in the personal name. You can do that every single month if you want to refinance. You're chasing that low interest rate, not ever going to be a tax problem.
Oh, awesome. Yeah. So like the story at the end of the day is like, hey, if you're inside of the S corporation, then we have to make some tough calls about what's going on and how can we possibly move that asset out, or what are we going to do? Maybe we have to sell it and then try to figure out what we're going to do because like, hey, that's just a bad place for you to be holding money. Is that the kind of decisions people end up with?
Yeah, exactly. Like, so yeah, I mean, and also, sometimes it's quick to rectify the situation. I don't know this particular client you're talking about. So if it's something that just happened, right? So it was worth 100,000. I moved it in, talked to Scott, realized it was wrong. You can probably move it out right away because odds are it didn't appreciate yet, right? It just, maybe it appreciated by $5,000. So who cares? And you can always contact appraisers to get the lowest appraised value when you move it out. So you're paying as little taxes as possible. There is something in the proposal. This is a very hopeful change if it comes up that's currently being discussed, is that they're wanting so they would allow S corporations to convert into LLCs or partnerships without a tax issue. So sometimes, you hear investor or CPA say, oh yeah, I just changed my S corp to an LLC. Well, when you do that, it's still treated as a taxable distribution. And so one of the proposed changes that, still being voted on or decided on right now is they're wanting to say, well, for S corporations formed before 1996, I think it's 1996 and earlier, that you can convert that to an LLC and not be subject to, recognizing gains. So we're very hopeful that that passes because it's super beneficial for investors who've made mistakes years and years ago. You can imagine what those properties cost that you bought in 1996. So we're really hoping that that gets changed. So,
yeah, I mean, it'd be fantastic if they can do some things to be able to help us out with some of those taxes coming through,
Yeah.
I do it. So that's awesome. So I think we cover it off on just about everything S corporation related. I wanted to give you an opportunity here too, Amanda, too, because I know that you just recently did a presentation here on like what are the proposed legislation coming through. And I think that also had to impact some things to do with like retirement account investing with inside of real estate as well too, right? Is that something you want to take 60 seconds and kind of brief on and kind of tease out where everybody should join in for your resource and presentation that's more about those proposed legislative changes?
Yes, of course. Yeah, definitely. If any of you guys are interested in what the proposed regulations are, check out our website. It's www.keystonecpa.com, where I think we spend like 30, 40 minutes talking about what the proposed changes are. And there are a lot of them, but as real estate investors, I know a lot of you guys are doing self-directed investing, something near and dear to my heart, because I also use self-directed investing into real estate, right? My IRAs, my 401ks. One of the things that they're looking to eliminate is our ability to self-direct into different types of funds. So you think private equity, syndications, apartment syndications, commercial syndications. And I know a lot of investors do that. And so what they're wanting to do is essentially take away the ability for a self-directed account to invest in anything that requires the investor to be accredited, right, based on net worth and income. And again, that's most syndication deals, most of these special deals that like a family office client would invest in, a lot of those could be prohibited. This is not law yet, it's something in the proposal. And so what we're asking everyone and all of you here is to contact your congressman, tell them to vote against it. You can check out our website, keystonecpa.com. I think it's /act now or something. I'm sorry, I don't even know my own website URL. But anyway, I have some resources, sample letters. You can write to your congressman, email them to try to get this passed. This is somewhat retroactive, meaning if you already have investments in self-directed accounts in a syndication, as an example, you effectively have about 2 years to unwind that transaction. Thereafter, potentially subject to taxes and penalties, which is very, very problematic.
Yeah, huge stuff, guys. So if you have those syndication investments, it might give you pause about wanting to keep an eye on what's happening here, because depending upon the timeline of your investment, you might be contractually have your money locked up longer than the period is that you have to unwind it. So you might be thinking about that before any new deals that you're getting into.
Yeah, and I do work with a lot of syndicators as well. So one of my jobs is to educate our syndicator clients, right? Because obviously as syndicators, it's also their responsibility to figure out if the law does pass, how do we get the investors out safely, right? And replace that, if it's a 50 or 100,000, how do we safely replace that with other eligible money, right? But we're not there yet, no need to panic and, start selling all the stuff, but something that we're keeping an eye out. And again, all of us here can do our role in writing our congressmen and women and, try to get that voted down.
Yeah, be a good citizen, write them up, right? Yeah, let them know.
Yes.
That's great, Amanda. I know we had talked a little bit before hopping on the show today, and I was wondering what was that next topic that we were going to hop to? Was that after?
I think there you have so many. Real estate professional.
Oh, right, real estate professional. That was the next fun one.
That little one, huh? That little one that nobody talks about.
That little tiny thing that we popped into. Yeah, I think that's where a lot of people are interested in. And I think a lot of people, right now, the belief of this group of people is to come in and say, well, great, if I can't be a real estate professional if I have any W-2 job. And the only way that I have, if I have a W-2 job that we can qualify as a real estate professional is like maybe if I have a stay-at-home husband or a stay-at-home wife, and that we can get them qualified as a real estate professional or designate them as a real estate professional. Of course, there's no certification requirement for that, but you have to be able to pass like the smell test of like, could real estate investing even legitimately be like your full-time profession for you, given everything else that you have going on there. And so given that that's like the belief, I was wondering if there's any additional information or any different framing that you have, or a different way to look at that issue that you see people thinking about when they're trying to figure out like, hey, how can I get a real estate professional designation?
Yeah, well, yes, you're exactly right. If you're someone who's not working full-time, maybe you're working part-time, or you have a spouse who's a stay-at-home, it's a much easier threshold to meet. And one of the benefits is when you are a real estate professional, all of your tax losses from the rentals can offset all types of income. That includes W-2, retirement distributions, stock gains. And so that's where it's kind of what, for us, it's like the holy grail of where you want to be. Maybe one person high income, the other person real estate professional, and then you just make a lot of money in cash flow from rentals and pay very little tax, right? But because the rules are that, to be a real estate professional, you have to spend at least 750 hours in real estate and more time in real estate than your job. That's where that full-time job becomes problematic, because if you're working full-time, let's say it's 2,000 hours a year in your job, then you need to have more than 2,000 hours a year in real estate. So that becomes difficult. I don't want to say impossible, because I have had investor clients in the past who worked a full-time job and claim real estate professional. But I will say it is very difficult. This particular person was someone who had a dozen local rental properties she managed. She ran a real estate club. She also syndicated deals. So it's a lot. It's more than just let me have 2 out-of-state passive investments and try to claim professional status, right? But also, being able to show that you materially participate in your rentals, meaning you're spending at least 500 hours on the properties themselves. But if you or your spouse is someone who can meet that profile, then, it's kind of like all, the gates open up and you have this significant tax savings, like some of these more sexy stories that, we talk about where someone saved, $100,000 in taxes or $50,000 in taxes, right? But having said that, just because you might not qualify as real estate professional doesn't mean there's no benefit to real estate investing, especially for those of you who are high income earners. Because what a lot of people don't talk about is that when you're making cash flow, let's say you have taxable rental income, that is taxed at your ordinary rate. So if you're at one of the highest rates right now, 37%, your rental income is going to be taxed at 37%. And so it is still really important to make sure we maximize our write-offs through income shifting, home office, depreciation, maximizing everything that we legally can, because then you can keep all of that cash flow and then utilize that to reinvest into more real estate, right? And also I think the other part of it too is real estate professional. For some people, it's a longer term plan. I know, sometimes people get discouraged and say, oh my gosh, I can't be a real estate professional this year. And this is it, real estate is not my thing. But you have to remember, you didn't get into real estate for tax savings. You got into real estate for cash flow, passive income, financial freedom, right? So if you can't qualify this year, keep on chugging, right? Buy more rentals, continue to buy more rentals, create more passive income that you don't have to pay taxes on. And so, sooner rather than later, you will get into a position where you, or at least maybe you or your spouse, one of you, can reduce hours at work, and real estate professional becomes a lot more easily achievable.
Awesome. Yeah, guys. So what I'm taking away from manager sharing is, if you can't qualify for it now, then think more long-term about how you can reposition, about like who's working, and do some calculus on like, hey, do we really need you to be working that much? Because look how much we could save on taxes. So maybe there's a win-win here where you can be actually cost neutral to yourself, but like, hey, I got all this time back, or my spouse got all this time back, and that makes our lives like so much better. Because at the end of the day, it's actually not just dollars and cents, right? We're actually looking for amazing lives, right? So maybe think a little bit longer term about that. And then the other piece too, I want to highlight for you guys as a tax attorney, or putting on my tax attorney hat here, is that if you're going to be doing anything that's going to be deemed as like aggressive, like I have a W-2 job and I'm going to claim the real estate professional designation. Anytime you're doing something aggressive, the best thing you can do is have really good documentation. Verifiable, good documentation that you're maintaining as you're going through, because that shows like a system and process about how you're approaching it. And that's how you're able to actually have good evidence to combat it. The people that get popped are the ones that are outliers and don't have documentation. Those guys get audited and they lose every single time. But people that are diligent with documentation and proactive with how they're organizing around it, those people have really good, actually have a fighting chance about if they ever get caught into like any type of audit scenario. And,
we see that all the time, where, for people who are married and, there's two spouses, the spouse, you look at the income, right? If there's a big disparity, so let's say you have a very high income earner and, someone who's not as high. If the other person, the lower income earner, let's say they make $50,000, but, again, federal and state tax rate, let's say it's 50%, net of taxes, they're bringing home $25,000. So if I can save them more than $25,000 in taxes by claiming real estate professional status, it makes sense to consider, right, for them to stop working because they're netting the same after tax. And then what does that, not only does it give them more freedom in their time, but also that allows that person to spend more time on real estate acquisitions management. And so they can grow their portfolio much faster and then retire that other working spouse, right? That's still going to be working for another year or two. So yeah, it kind of comes down to the numbers, and oftentimes the decision to work less or stop working is much easier than people think, when they're looking at the actual numbers.
Oh man, I hope everybody's ears just perked up when they just heard like, wow, there's a place for us to stop working. Amazing. I was like, how much happier would your spouse be if you're like, no, no, just stay at home. That's it. Just do your thing, like it's fine.
Yeah.
Actually, save money and be able to have more time. This is amazing.
Yeah, I do want to bring something up since we're talking about real estate professional status, because we are seeing a lot more investors deal in the short-term rental space. So I do think it's important just to address that. For those of you who are involved in short-term rentals, and this means your average guest is staying less, 7 days or less. For short-term rental operators, if you have losses, okay, if you have rental losses, whether natural or strategically created, but with you and your CPA. So if you have those losses, you might be able to use it to offset W-2 and other income, even if you don't qualify as real estate professional. So it's kind of a little, loophole in the tax law where short-term rentals aren't subject to the same strict requirements as long-term rentals. And so in the short-term rental space, they don't care how many hours you're spending at your job. Okay, so you can work 2,000 hours, both of you working, it doesn't matter. To use the loss, you simply have to be able to show that you, what they call materially participated in your short-term rentals. There's 7 different ways to qualify, but the 2 most common ones that I'll just mention here is one that you and your spouse spend at least 500 hours on the short-term rental properties themselves. So that's acquiring it, staging it, maybe managing it, dealing with turnovers, all that stuff that you're doing for the property, at least 500 hours. Okay, so that's one way to meet the qualification. If you don't meet that, there's another way to meet that, which is you spend at least 100 hours on the short-term rental and no one else spends more time than you. So you're looking at how many hours you're doing versus how many hours maybe like a property management is doing, or the cleaning crew, or the gardeners. So you have to do at least 100 and more time than one of those people. So those are the 2 common ways to qualify for material participation. And again, could be hugely beneficial, because I'm seeing people buy short-term rentals for, I don't know, $700,000, $1 million. Just the other day, someone bought it for $1.5 million. So that's some very big write-offs. And if you can meet those qualifications, those write-offs can potentially put a pretty big dent in your taxes from your W-2 income.
Pretty fantastic. Yeah. So to be like, because they'll take it as like from active income and then apply it to active income, right? Because short-term rentals are treated as active income, whereas your other rentals are going to be treated as passive income. And that's why you have to have that other designation, right?
Yeah. Yep.
And we talk about that a lot about how you need to separate active and passive income because of the different tax rates and why is that important for us. So that's a hot tip. That's new to me too. I had never heard that the loophole around the short-term rentals. I'm going to be starting telling everybody in my network and pretend like I was like, oh, I knew this all along. All right. No, as you got to tune into these shows to be able to find out what's really going on, what the real hot tips are. Cool, man. I know we have a couple more minutes here before we wrap up. What do we have? Is there any other topics that you have top of mind for us here that we had talked about that you want to cover off on before we have that opportunity to direct everybody about where to stay connected with you and all the great tax teaching you're doing?
Yeah, one other important thing on real estate professional status, I want to make sure people know is regardless of whether you're a real estate professional or not, you get to write off the same expenses. So you can still write off an eligible car, an eligible home office, shift income to your kids. There's nothing different about that if you're not a real estate professional. The only difference is that if you're not a real estate professional and you are of higher income, you can't use the losses to offset W-2 in that given year. That's really it. And also you don't lose those expenses and losses. You carry them forward and you can use it in a future year. Let's say in the future when you do have taxable rental income or you have other passive income from, syndication investments or business investments that you're involved in, or, worst case scenario, when you sell the property, you get to utilize all of that to offset capital gains. So, really, really important to continue to track and have a plan in place and not just kind of, forget about it just because you're not seeing an immediate dollar saving today, especially since, the expectation is tax rates are on the rise. So every dollar saved might be $2, it might be worth $2 of actual savings in the future when we're applying it against a much higher tax rate. right? So I think that's kind of the main thing, because I do see or meet investors who kind of get discouraged and say, oh man, I thought I was gonna be able to slash my taxes significantly right now, but I'm not able to do it. And then also outside of real estate, I know, Scott, you talk to clients a lot about that. There's other ways to reduce taxes with retirement contributions too. If you have an S corporation, solo Ks, defined benefit plans, we have clients putting $100,000, $200,000 away and getting a tax write-off immediately. So other sort of alternative strategies as well beyond just the real estate professional status.
Yeah, and for those higher contribution limits that you typically see, I think the solo case like cap out around like that 57-ish, depending upon age, type of bracket. And to get to that higher level of like putting it away, you need those defined benefit plans. Is that right?
Yeah. And so, you say 50, 57, 58,000 per person, right? For a couple, that's over 100,000. And then you add the defined benefit on top of it. That's where, you can see that snowball effect. And of course, once the money's in the retirement account, whether in this, solo K or the defined benefit, you can utilize that for real estate, right? So it's sort of a double benefit of getting a write-off immediately now and also deploying that towards real estate investments.
Amazing, Amanda. Well, thank you so much for all of the awesome knowledge that you've dropped on us here today. Of course, Amanda, and for everybody that would want to stay connected to you and continue to learn from you, like what's the best way for them to do that?
I think our website is probably the best place to start. And again, that's www.keystonecpa.com. If you're interested in some of the foundational strategies, definitely download our free ebook on tax strategies for real estate investors. We talk a lot about how to shift income to your kids, again, the tax deduction, examples of what to and not to do for real estate professional status. We touch on legal entity structuring, what to avoid. So definitely check that out. And like I said, we're expecting a ton of tax changes in the coming weeks or months. And so we're constantly updating our content. So on our website, you can find information on our next webinar on tax updates. So that's the best place to find me and stay up to date on the latest and greatest.
Awesome. Everybody go check out Keystone CPA and check out the great resources that Amanda has there. That we do a lot of our own updates on legislative updates and other updates, but this is like a network, team kind of thing, right? So the more you can stay plugged in on to the information that people that we're introducing to you here in the network, the better off you're going to be. Because the more you're going to be informed yourself and the more helpful you're going to be in terms of this community of bringing in new ideas, different strategies, different viewpoints, different ways of thinking. And that's the healthier and the stronger that we all become. So I encourage everybody to reach out to Amanda's website there and be able to grab that information and start studying some of her great materials and bring that information back into this community. Right. And let's have those conversations of like, what are the things that we're learning that are making ourselves more adept at being better and better investors. So that way we're really in that top 1% of who's in the game and what do those people know. So thank you so much, Amanda. I hope you have a fantastic day. Everybody go check out Keystone CPA.